You seem troubled. What seems to be the problem?
Well, I told my parents that I wanted to move out, and they were happy for me.
That should be great news, right? You're finally going to be on your own.
Well, I really wanted to prove a point to my folks and show them that I finally made it by buying a house. So I was looking for some digs with a great view and a huge backyard, for parties, some 4 bedrooms and some 4 smashing bathrooms.
Wow. I had no idea you'd saved up that much money.
See, that's the problem. I don't. I'm not sure what I'm going to do now. My dad has already made plans to convert my room into a game room. His huge flat screen TV is coming kesho.
Wasi, you don't necessarily have to buy right now. You can always rent a place, and given your financial situation, it might make the most sense.
You really think so, Judy? Can you help me with the process?
No problem, Wasi. Let's go find a place. What you may not know about potential homeowners is that they're drawn to home ownership not for financial reasons, but for sentimental reasons. Owning a home allows you to put down roots and potentially start a family. There is a pride that comes with home ownership. This property and land is yours. It's great to aspire to own your own home, but you may realize, depending on your current personal or financial situation, you may be better off renting a home. Let's dig deeper into a variety of factors that may influence your decision to owning or renting a home. Home ownership, the good, the bad, and is it right for you? Let's start with the good. So, as you've already learned, the pride of ownership is a great reason to buy a home. What does it mean? It means you can decorate your home according to your own taste, turn up the volume on your music player, throw parties, and build a family and priceless memories. Homeownership also gives you and your family a sense of stability and security. It's making an investment in your future. Another reason is for the appreciation of property. Appreciation is an increase in the price or value of something you own. In this case, it's your home. Conversely, if your home decreases in value, it is said to have depreciated in value. Although property prices move in cycles, they have consistently appreciated. Let's look into appreciation further. Assume you bought your home 5 years ago for 6 million shillings. Today, the home is worth 7 million shillings. Your home is appreciated by 1 million shillings. That's a 16.67 increase in the value of your home. However, a more appropriate measure would be to calculate the average annual appreciation over the 5-year period in which you've owned the home. First, divide the final value, 7 million, of the investment from the initial value, 6 million, of the investment to arrive at 1.167. Second, raise the result from step 1 to the power of 1 over t, with t being the time in years the appreciation took place over. Continuing the example, you would raise 1.167 to the power of 1 over 5 to get 1.0313. Third, subtract 1 from the result to arrive at 0.0313. Finally, multiply the result from step 3 by 100 to find the annual appreciation rate. Therefore, the annual appreciation rate on the property is 3.13% per year. Although your property appreciated by 16.67% over 5 years annually, it only appreciated by 3.13% per year. Here's a diagram which illustrates annual appreciation of your property over 5 years. In addition to your home appreciating by value, your home may also qualify to receive unique tax benefits. It's important to consult competent legal and accounting advice to find out which benefits you may qualify for.
Atiheji, when you are gardeners.
In simple terms, owning a home provides protection against inflation. So you may be wondering, what's inflation? And what does it have to do with home ownership? Let's start with inflation. Inflation is a sustained increase in the general level of prices for a broad range of goods and services. And as a result, an individual's purchasing power decreases. Therefore, as inflation rises, every Kenya shilling you own buys a smaller percentage of a good or service. Let's use a basic example to describe inflation. Assume the annual inflation rate is 5%. Wasi would like to start a new tradition of handing out cupcakes to his friends for his birthday. He allocates 2,000 shillings per year for cupcakes to hand out. Today, with the price of cupcakes at 100 shillings, he can purchase 20 cupcakes for his friends. A year from now, with the inflation rate of 5%, the cupcakes will cost 105 shillings. Therefore, a year from now, Wasi can only purchase 19 cupcakes with his 2,000 shillings. So as the inflation rate rises, the amount of goods and services that can be purchased with Wasi's 2,000 shillings has decreased. Therefore, we can say the purchasing power has also decreased. So how does homeownership protect your investment from inflation? In the most general terms, many believe the price of your home will rise with the inflation rate. Let's use an example to illustrate how this can benefit homeowners. Suppose you bought a home today for 6 million shillings. Typically, individuals put a down payment on the property that may range between 10 to 30% of the value of the property. Let's assume you put down 20%, which is 1.2 million shillings, and you borrowed the rest, 4.8 million shillings. The 1.2 million shillings is often referred to as your home equity. Home equity is the difference between the home's fair market value and the outstanding balance of all debts on the property. In this example, your home's market value is 6 million, while the debts are 4.8 million. Therefore, the home equity is 1.2 million. This figure will fluctuate depending on the appreciation or depreciation of the value of the property. The 4.8 million shillings you borrow is often referred to as your mortgage. A mortgage is a loan given to you by a bank, mortgage company, or other financial institution for the purchase of a home. Now, let's revisit the example in which you purchase a home valued at 6 million shillings. If, a year from now, the economy soured and the inflation rate rose to 20%, however, you were fortunate to find a buyer to pay you 6.6 million shillings for your home, therefore, you realized a 600,000 shilling profit. After you pay off the remaining balance of 4.8 million on your mortgage, you're left with 1.8 million shillings. Therefore, your home equity of 1.2 million shillings was turned into 1.8 million shillings. In other words, in a year, your initial investment appreciated by 50%, thus protecting your cash from the high inflation rate. Not bad, huh? Although this is a simplified version, it explains at a high level how a home can provide protection against inflation. Clearly, there are many factors which may impact the value of your home. Over time, as you continue to make payments on your mortgage, the home equity will build, even if the value of the home does not increase. Now for the bad, owning a home is expensive. Although a homeowner's monthly mortgage payment may be less than their previous rent payment, a homeowner may also incur additional costs, such as taxes or insurance. Furthermore, potential owners are required to provide a significant down payment and pay approximately 7 to 9% of the property value to cover costs associated with acquiring the property. These costs may include legal, stamp duty, commitment, and appraisal fees. You won't be as mobile. Once you own a home, moving isn't as simple as giving the landlord notice. If you anticipate a move in the near future, this might not be the ideal time to buy a home. The repairs for your home are your responsibility. Need to repair the roof, replace a generator, or hire security, or someone to maintain the lawn? You have to pay for it yourself. You have to do all the upkeep. As we discussed earlier, a mortgage is a loan given to you by a bank, mortgage company, or other financial institution for the purchase of a primary or investment residence. However, a mortgage is more than just a loan. If you fail to pay back the loan, the lender can take your home through a legal process known as foreclosure. Therefore, the lender can force the sale of your property if you have stopped making payments on the mortgage in order to retrieve the principal and interest it is owed. Whether it's from a job loss, medical emergency, personal financial mismanagement, or mortgage payment hike, A small but growing number of homeowners fall into foreclosure every year. Your monthly mortgage payment may fluctuate, which may result in you falling behind on your payments. Fixed rate mortgages and adjustable rate mortgages, ARMs for short, are the two primary mortgage types. A fixed rate mortgage charges a set rate of interest that does not change throughout the life of the loan. Because the total monthly payment remains constant with a fixed rate mortgage, the borrower is protected from sudden and potentially significant increases in monthly mortgage payments if the interest rate rises, which typically protects homeowners from falling behind on their payments. However, the interest rate for an adjustable rate mortgage, ARM or ARM, varies over time. The initial interest rate on an ARM is set below the market rate on the comparable fixed rate loan, and then the rate rises as time goes on. The ARM may have a fixed period of time during which the initial interest rate remains constant, which is often a teaser rate, and after, the rate can adjust. Initially, ARMs may seem very affordable, with low interest rates. However, as ARMs can be more problematic in high inflation environments, which can result in large swings in the interest rate. If the economic environment remains unpredictable and volatile, homeowners with adjustable rate mortgages may see their interest rates vary between 15 to 30% or even higher. A spike in the interest of your ARM can result in mortgage payments which no longer fit in your budget. Falling behind on your mortgage payment is a serious matter, and you should contact your lender immediately. Most lenders offer programs where they work with the borrower on payment plans that meet the borrower's financial circumstances. Although the fair market value of most homes has increased over time, there's no guarantee the fair market value of your home will appreciate. There are many perks to owning a home. Make sure that you also consider the downside before you make your purchase. Now that we've seen the good and the bad of owning a home, how do you know if it's right for you? Buying your home is a personal decision that you should make independent of what the market may or may not be doing. If you're looking to make the long-term commitment of home ownership, it helps to approach the decision like you would any business decision. You don't want to buy on emotion or because someone else is doing it. Here's a list buyers should have addressed before they consider purchasing a home. Number 1, have a budget. If you cannot afford the increased expenses that come with a home, then it's never a good time to buy, no matter what's happening in the real estate market. Number 2, have a down payment. Traditionally, you'll be required to make a minimum down payment between 10 and 30% of the fair market value of the home. So, if you're considering a home valued at 8 million shillings, you'll need 1.6 million shillings up front. Buyers are also required to cover costs associated with acquiring the property. Number 3, have a reliable source of income. Buying a home is a long-term financial commitment. Therefore, you'll need a consistent stream of income to cover monthly mortgage payments. 4, establish an emergency saving fund. It is suggested that you have enough cash to cover 6 months of your living expenses. In case of an unforeseen event which could impact your income, it's critical to have enough savings to make your mortgage payments until you can get your financial situation sorted out. 5, you're ready for a long-term commitment. Buying and selling a home can become costly. It's important that you're willing to commit to settling down. 6, you're ready to become your own landlord. The repairs of your home are your responsibility. You have to do all the upkeep. 7, manage your credit history. When a bank decides whether to loan you money for a home, one of the things it's going to look at is your history as a borrower. Banks can contact a credit reference agency or bureau for information to help them make a decision on whether or not to open an account or provide loans. Therefore, someone who has failed to pay their loan at one bank will not simply be able to walk into another bank to get another loan without the bank knowing about it. Over time, Borrowers with a good credit report or good credit history will be able to access loans more easily and at favorable interest rates. Think renting a home is a better option for you? Let's consider the positive and negatives of renting. We'll start with the positives. Less work required to maintain a home or apartment. Unlike owning a home, renting does not carry the responsibility of maintaining the property. If you need to fix the building's generator or broken pipe, call the building's landlord. Flexibility to move. Are you starting a new job in a new location? Do you need more space to accommodate a growing family? Do you feel unsafe in your current neighborhood? No problem. When the lease is up, you can just move. You may be able to leave prior to your lease expiring, but you may be charged a fee. Although you're not building home equity, you're also not losing it either. With renting a home, you're eliminating any risks associated with your home decreasing in value. Financial flexibility. Have you lost your job or have a medical emergency and need to downsize your home in order to save money? You're able to walk away from your lease with usually only a small penalty. Also, because monthly rent payments remain constant, this may allow renters to more effectively plan and contribute towards specific saving goals, such as retirement, college, future travel, investments, or even putting away money for a down payment on a home in the future. Requires a small amount of upfront cash. Unlike buying a home, which requires a significant down payment in cash to cover additional fees, renters may only be required to pay a few months in advance rent to secure a place. There are downsides to renting a property. You will never gain home equity or tax benefits. No matter what happens with the value of the home, you will never gain equity. Therefore, the money spent on rent is not applied towards ownership and does not build equity. Furthermore, you'll also not realize any potential tax benefits that are typically reserved for homeowners. Lack of control of the property. You'll have to get the landlord's approval to paint the walls or remodel the interior of the property to your taste. Financial disadvantages. The landlord has the ability to raise the rent with appropriate notice. If you cannot afford the additional costs, you'll have the expense and inconvenience of moving.
Judy, hey, I really like my new digs. I can't believe the apartment compound has its own swimming pool. Pool parties all the time. Hey, I'm going to party.
Wasi, I'm so glad you're happy. Just don't forget to invite me to your parties, okay?